Welcome back to another episode of Marketing, Management, and Money. I am your host, Ryan Murray.
And I'm your host, Ryan Owens.
So today we are going to dive into the finances, but we're going to get nitty gritty. We're going to dive into some financial ratios, and we're going to be covering some calculations. This one's going to get a little bit deep, but I can tell you this. You need to know this stuff.
Absolutely. This is really, really good stuff. It's going to be dealing specifically with our income statement, and that's not something that a lot of people get the value out of it that they really should, right?
Yeah.
And so by learning these things and taking the time to understand them and implement them,
Were you saying?
I was iterating.
Oh, okay.
If you take the time to do that, it'll provide some really solid value for your business.
Because here is the mistake. And if you are in this boat, you need to get out of this boat and you need to start doing things correctly. But this is the mistake. So many times businesses fail to use their financial statements as a powerful tool, and instead it becomes a tax document at the end of the year. Oh crap, I got to do my taxes, so I better put this stuff together, give it to my accountant, and never look at it again. That is a huge mistake, but it happens all too often. You've got to use your financial statements as a tool, but you got to understand how to do that.
Yeah, it really is such a, I hate to call it a failure, but it really is such a mistake. You know,
You can use the word failure. My feelings aren't hurt.
I know, but we know that you're kind of harsh. So, but it really is like stepping over this pot of gold of information that you can use to run your business so much better. Mm-hmm. So please just do it. Just learn it and do it.
So let's start with a little bit of what financial ratios are.
Sure. Okay.
And why we even care about these things. Because if we don't lay the premise, this is what I'm afraid is going to happen. And I'm going to warn our listeners up front because I don't want you guys getting sucked into this trap. And that is, this can get a little tedious, or it can feel a little tedious.
Yeah.
It's really not that bad. You know, these are some basic calculations. We're not getting into anything too deep in terms of the math, but it can feel a little bit overwhelming. And so as we go through these calculations, I don't want you guys tuning out. I don't want you guys saying, oh, that's not for me, because it is for you.
Yeah.
Now, a financial ratio is nothing more than making an apples-to-apples comparison. So here's the deal.
And let me iterate that really quick.
Okay.
It's apples to apples. Like, you're not comparing two totally random things. It's and as you go through this, you want to make sure that that's part of it. You're comparing the correct things, right?
Yeah. So I'm going to take something and I'm going to divide something else into it. That's the calculation of a ratio. It's a division calculation, and it's either going to end up as a percentage, it's going to end up as a decimal, it's going to end up as, maybe even a number that might be greater than 1, but regardless, it's going to help us tell a story. Yeah. And that's the power of ratio analysis. Is what it does is it takes the numbers out of a numerical context and it puts them into this story where I can literally see what is going on in my business, and I can understand if I'm growing.
That's such a great way to put it. It really is your business's story.
Yeah, and one of the things that you always have to hear me say, and you probably get sick of it, is I love things like when you look at a business and you say, okay, am I increasing at an increasing rate or am I increasing at a decreasing rate? Because I'm increasing in both instances.
Right.
But if I understand the rate at which I'm increasing, all of a sudden I can tell you, what phase, in the life cycle of either a product or the business, what phase am I at? Because then I know what phase is coming next, and I can plan for these things.
Yeah, exactly.
Exactly. A lot of information in this, so we got to get through this. It's not going to be that bad if you follow with us.
Sure.
So
it may be one that you want to listen to a couple of times, until you get that kind of routine down where it's like, okay, this is what I'm going to do. This is how I'm going to use these things. So by all means, use this as a tool to get you to that point.
Yeah. So let me give a high-level overview of the ratios that we're going to cover,
Okay.
and then we'll kind of dive into them. So we're talking about income statement ratios. This is measuring the profitability of your company. That's what we're looking at today. So we're looking at the profitability of your company off of the income statement. If we remember from previous episodes, the income statement is also the profit and loss, the P&L. It's all the same thing. And so we're taking information from those statements. Now, if I have a bad P&L, if I've got bad information, if I failed to put together the correct information, none of these ratios are going to matter. It's going to be just garbage.
Mm-hmm.
And so make sure that you've got quality information that you're starting with, and we're going to dive in. So there are 5 ratios that we want to cover today: sales growth, contribution margin, break even, gross margin, and profit margin.
Yep.
Those are the 5. Let's kick it off, Ryan.
Yeah,
Why don't you take us through sales growth?
Sure. So sales growth is actually pretty simple, right? So it's just the ratio. It's the ratio of sales growth. So it's a percentage change year over year that your company is experiencing. So the goal here is obviously to have growth, and not just growth. You want consistent, steady growth, and
manageable growth as well.
Exactly. So I don't know that this is something we want to go into right now, but it'll help us look for, or it'll help us identify things that may be coming that we want to prepare for.
And all ratios will help us see things within our business.
Yeah, exactly.
And so I think that this is kind of something that we want to at least let our listeners be thinking of as they go through these ratios, because as we talked about earlier, there's a story behind all of these numbers.
Right. Okay. So how do you calculate sales growth? Calculating sales growth, again, is really not difficult at all. So you take your current year's sales, and the first thing you do is you subtract your previous year's sales from that. So current year sales minus previous year's sales. Once you have that total, you divide it by that same previous year's sales, and it will give you the percentage of growth between last year and this year.
Mm-hmm.
There you have it. Easy peasy.
Easy peasy.
And so you can look at that from not just last year to this year, but you can look at it year over year over year and get that trend line and make sure you're having steady growth. Make sure you're having manageable growth. Make sure you're managing your growth correctly.
Mm-hmm.
So
yeah, beautiful. So that one, I think a lot of people are pretty comfortable with, because this is something that they're probably already doing.
Hopefully,
Most businesses are looking at some sort of growth ratio,
and if you're not, it's an easy one to get into. It's like a gateway ratio.
Oh, welcome.
Yeah, first one's free.
Oh, geez.
I had to drive it home. You didn't get it.
Okay. See, I was thinking gateway, like I know, in my mind, I was going to Disneyland. The gates just opened and I was a little kid. You weren't going there.
Oh, I was taking you to Disneyland.
Yeah. You were taking me to a theme park. It just wasn't Disneyland.
Oh, the financial ride of a lifetime.
Oh, jeez. Okay. So next one that we're going to jump into is contribution margin. Now, contribution margin is really what's left over to cover your fixed cost or your fixed expenses. We did an episode just a few weeks back on break even where we talked about contribution margin.
Yeah.
And in this one, we're going to just give you the calculation. And honestly, so contribution margin doesn't necessarily need to be in this mix of ratios. It's just such an important step to get to break even.
Yeah,
and
exactly.
And it helps you kind of understand break even a little bit better. So
for sure.
Me personally, when I am doing my own ratio analysis, I just do break even because it covers contribution margin in it. But this is your first step to break even. So let's go ahead and do the calculation. So the calculation is 1 minus your variable expense percentage. That's what the calculation is. But let me break that down because that might be a little bit confusing if people are like, whoa, I don't even know what you just said.
Yeah, you didn't go from 1 to 60. You went from 45 to 60.
So
and people are waiting at 1 like, wait a second.
So in every business, I've got my fixed costs and I've got my variable costs.
Yep.
Fixed costs are those costs that are going to be there whether or not I have sales. It doesn't mean that they don't move. That's a common misconception. It just means that they're always going to be there. So things like rent, things like a lot of my labor costs are going to go into a fixed cost. My utility bills, these kinds of things are all going to go into a fixed cost. And so when I'm looking at my expenses, I'm going to break out my fixed costs. And then everything that's left over becomes a variable cost. Variable costs, they move in relation to sales. Mm-hmm. And so if I'm purchasing goods to turn around and sell,
right,
that's a variable cost. If I have some direct labor to manufacture those goods, that's a variable cost. If I offer sales commissions, that's a variable cost. So I'm going to take all of these costs, these variable costs, and I'm going to take them as a percentage of sales. And that's going to be my variable cost percentage or my variable expense percentage. And then all I need to get is the inverse of that. That's why it's 1 minus variable expense percentage. So if 35% of my sales, for every dollar I sell, if it costs me 35 cents to manufacture my widget, I have a 35% variable cost. I take 1 minus the variable cost. My contribution margin is 65%.
Beautiful.
Did we cover it okay?
We're all caught up.
Okay.
We're all at 60 with you now. So the next step is your break even. And I think this is a really funny one to approach a lot of times because people, they shoot for that break even. They want to go for that break even. But here's the kicker. Break even equals 0. Like break even is 0.
You accomplished nothing.
It's not that you've accomplished nothing. You've accomplished quite a bit, actually. It's just that, you've got to keep going a lot beyond that to make it worth it, right? So we talked about the risk versus reward in a previous episode, and you've risked a lot at this point, and you have yet to see the rewards of it. So we want to keep moving past that. We want to be able to calculate this break even and move beyond that.
Okay.
So the break-even point is, again, it's at which point your sales cover all of the expenses of your business. There's no profit and there's no loss, right?
Mm-hmm.
So, again, it's once you have that contribution margin, that's why it's so important to include this. And again, it can add some valuable insight into your business by calculating that and looking at contribution margin. But you take your fixed expenses. So we talked about separating those out. Now we're going to bring those back in. We're going to take your fixed expenses and you're going to divide that by that contribution margin percent that you just calculated in the last ratio.
Mm-hmm. And so we went a little fast on this one. If you want to dive in deep, the episode that we just did on break even is really where you're going to want to jump in because we take you through some actual examples, some numbered examples to show you break even and contribution margin, how to use break even. But all I really want to cover in this episode is the reminder that these are all helping us understand the profitability of the company.
Yeah.
If I have sales growth, but my break even is getting chipped away, if it's getting harder and harder and harder to hit break even though my sales are growing, the story is, watch out, buddy, you're in trouble.
Yeah.
And so
you're becoming less efficient.
Yeah. And what I'll see all the time is I'll see these businesses that they will focus so heavily on sales growth and they'll ignore this break-even piece. And then all of a sudden they wake up one day and there's they're
in hot water.
Yeah.
Like, what in the world just happened? We were doing so good.
Mm-hmm.
And now they can't pay their debts and they can't,
Yeah. They're just not where they thought they would be with all of these, all these sales numbers coming in. And so you're really looking at the full story going on with profitability. And, the story starts with sales, but it ends with profits. And you have to have both. And break even really tells you what's going on with that.
Yeah, these are all indicators as to how healthy your business is, how well you're managing and running your business.
And so let's jump down. We've got the last two that we want to cover. We've got this gross margin and we've got this profit margin. They're essentially saying the same thing, but one is looking at kind of these, maybe the what do I want to call this? At your gross margin, all we're taking out is we're just looking at the gross profit, and we're saying, I'm just looking at like my cost of goods. I want to know, what does it take for me to sell my goods?
Yeah.
Now, I'll tell you, and I've had some different accountants disagree with me on this, but I'm going to apologize to, all the accountants out there who are listening. And, if you want to call me out on it, go to, our Twitter at MMM Small Biz. And, you can tweet how I'm completely wrong here, but I'm going to hold true to this. And that is, if I have a cost of goods sold, it means I sell goods. If I'm a service-based company that does not sell goods, I do not have a cost of goods sold. Therefore, I don't have a gross profit. Therefore, I don't have a gross margin. So you really only want to calculate gross margin if you have a cost of goods, and you really only should do a cost of goods if you're a product-based company, not a service-based company.
So I want to insert something here.
You want to redeem me?
No.
Redeem you.
So if there's backlash on Twitter, which I assume there will be, I just want everybody to know that while he's out there staking this claim on, he's
falling on my sword,
die on this hill, I'm going to be cowering back here in the shadows, letting it happen. So if you're going to call him out, MMM Small Biz on Twitter, call out Ryan, not Ryan.
Oh, okay.
Super easy. Just make that distinction.
Oh, man. But, when we're talking about the margins, this, when people say I've got good margins on that product, that's what they're saying, is they're saying, what's the gross margin? The calculation is simple.
Yeah.
I take my gross profit, I divide it by sales, and that gives me my gross margin. So a super easy calculation, but it really only comes into play when you're a product-based company. And I'll tell you, any good, production manager, they know this stuff.
Yeah, exactly.
This isn't new stuff. And so if your production manager doesn't know this stuff, you probably shouldn't have hired your nephew.
I was going to say, I feel like at least half of our audience just laughed at us. If you're a production manager, they're like, what production manager? My nephew doesn't know jack.
So, but the one that I care about is profit margin, because this goes with every business. Every business has a profit margin.
Bingo.
And I like to look at it this way. So I use this little saying: for every dollar of sales my business has, whatever your profit margin is in terms of cents, to, in profit. I said that really complicated, didn't I?
Yeah, you could try again.
Okay.
I'll let you try again.
Take two.
Rewind.
If I have a 10% profit margin, for every dollar in sales, I have 10 cents in profit.
Sure.
How did I do that time?
That was better.
Was that better?
Yeah.
Okay. So the calculation on profit margin is just my net profits over my sales.
Yeah.
That's all I have to do. And the thing that's so interesting is we're trying to drive profitability. You can't spend sales.
Right.
You can only spend profits. The owner gets to take home profits. They don't get to take home sales.
Exactly.
And so if I'm losing margin, but my sales are increasing, that starts to become a red flag.
Yeah,
That's the story that is being told here.
exactly. And so, again, a lot of these things are looking at the health of your business and the effectiveness thereof, right? So, your sales growth is looking at how much you're growing year over year, so you can then come back to make sure you're managing that appropriately, make sure you're watching that. Contribution margin, break even are really looking at making sure that your efficiencies are where they should be and that you're not going to go out of business with record sales, right?
Yeah.
And then the same thing with gross margin. And I'm going to step back into the ring here. I also like profit margin a lot better. But again, with profit margin, making sure that your profits are where they should be. That as a business owner, that your reward is there. You made this risk, you overcame the risk, and now you get to reap your rewards. That's what this is all about, right?
Mm-hmm.
Otherwise, why are we doing it?
Right.
So,
I want to I want to let our listeners know that when we go through these financial ratios, first off, we're going pretty quickly because on a podcast episode, it's a little tricky to get into ratio analysis, but it's important, and that's why we're doing it. Is because find another show out there that's willing to tackle this important of a topic that's difficult to do. But if we went too fast, I would recommend that you look it up. You can find all of these ratios. They're pretty common, and so you can find them easily online and go through and run a couple examples and reach out to us with questions or whatever you have. We're going to be continuing with other ratios, and we're going to go ratio analysis. I will tell you that here at Marketing Management and Money, we use 17 different ratios. That's what we focus on, is just there's 17 ratios. You might have more or less that are going to work for you, but these are the ones that we're going to cover. And so in future episodes, we'll be getting into, the balance sheet ratios. We're getting into the cash flow ratios, and covering all of these topics. So we appreciate you being with us.
Yeah.
Sticking to it and hanging out the whole time, and hopefully you learn something.
Yeah, absolutely. If you want to reach out on Twitter, that's at MMMSmallBiz. If you want to fight with Ryan about these ratios, by all means. If you want to give the other Ryan, me, a high five, do it on Twitter at MMMSmallBiz. We also have trainings that can go through this more in depth. Feel free to reach out however you need to. We look forward to another episode next week. We'll see you then.
Yeah, and be sure, subscribe, share the love.